Welcome to the MUFG Global Markets FX Week Ahead podcast with Derek Halpenny, Head of Research, Global Markets EMEA and International Securities. It's Friday, 22nd April 2022, and joining Derek to pose some questions on the financial market themes for the week ahead is Simon Mays, Director of MUFG's Global Customer Marketing Group for EMEA in London. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Good afternoon, Derek. How are you doing?
Afternoon, Simon. All good. Thank you.
Excellent. So we've had another interesting week in the markets, and for MUFG in particular, there's been quite a bit of focus on the move in dollar-yen. And we hit a high of 129.40 on Wednesday before correcting a little bit lower. So what's been behind this latest move higher, and do you think the move may finally be coming to an end?
We did a very interesting week, and that level you've mentioned, Simon, 129.40, that's the highest dollar-yen level since April 2002. And I guess it's kind of the same story as before, but obviously the markets have really latched on to comments from the likes of Bullard and others at the Fed suggesting a number or a series of sizable rate hikes. Bullard mentioned 75 basis points, and the markets have even started to partially price in the prospects of that over the next two meetings. But there's now 4 50 basis point rate hikes priced over the next 4 meetings, and the 2-year has marched further and further higher, and that's been the primary catalyst. And then on top of that, of course, the trade situation in Japan with the with commodities and fuel prices, with fuel, raw materials, and food making up nearly 40% of Japan's total import bill. There's increased sensitivity to a worsening trade balance on higher prices. So, the fundamentals for it is pretty clear. And as I've said earlier this week, we're now within the realms of talking about intervention with a much higher degree of credibility. 5 big figures ago, it just wasn't a credible story to discuss. But now it is. And of course, Finance Minister Suzuki has spoken very, very clearly about sudden moves not being desirable, and that FX rates were being monitored with a greater sense of urgency. And of course, he was very eager to mention the fact that he'd spoken with Janet Yellen on FX. Now, he didn't explicitly talk about the idea of intervention, but the G7 remit, or the agreement within the G7 on FX, is that when you have excessive and disorderly moves, it can have negative implications for the economies. And therefore, I think there is the justification within that for intervention, because the scale of the move over a 2-month period, if we get up to 130, over a 2-month period in percentage terms, it will be over 13% higher in dollar yen. And that will be the biggest 2-month move in dollar yen since August 1995, when the G7 intervened to buy dollars. So it's the scale of the move is very, very significant. However, the idea of joint intervention, which has been speculated on in Japan media today, I just don't think is going to happen. The fundamental story that I've just mentioned means I think the Fed would be very, very reluctant to get involved in any kind of joint action. Of course, that would mean the Fed selling the dollar, with the US Treasury Department instigating dollar selling at the very same time, and the Fed are about to hike rates aggressively to fight inflation. Complete mismatch and inconsistency, and I just don't think the Fed would get involved. But certainly from a Japan alone perspective, it's definitely very plausible. And I think if we do get to levels over 130, and importantly on top of that, we get something from the BOJ next week in terms of some element of a policy shift, it could open up a window for some kind of action just to kind of bring some better two-way flow into the markets with the fact that Japan has acted to try and stem the scale of yen weakness. But I do stress, I think something from the BOJ next week will be really important. At the moment, the guidance from the BOJ is still biased to further easing, which now I think is ridiculous. And I think they'll scrap that bias next week. Also, we've had a number of unlimited purchase operations of JGBs to keep the 10-year yield capped below 25 basis points. And again, that's another reason why the Fed would never get involved with joint intervention when the BOJ is doing such an aggressive easing action. But I think, again, next week, the BOJ could move away from yield curve control, either by signaling the potential for a change or widening the range. I don't think they'll actually act next week, but Kuroda could announce a policy reassessment, which in 2021 was a signal of a potential change in yield curve control. And I think if there's a change in guidance, along with a hint to a change in yield curve control, that is clearly a shift from the BOJ. And if dollar yen is at levels, as I said, over 130, then I think there is certainly a chance that you could get intervention at those levels. So it's a plausible, credible story to be discussed in the markets now.
Thank you very much. Very interesting. And as you mentioned then as well, I guess the US yield story has been a big influence for the dollar. We've also seen the pound falling hard against the US dollar today, and the break below 130 seems pretty notable. So how low do you think we can go from here? And I guess what should our listeners look out for over the coming weeks?
Yeah, no, I think this breaking 130 is a big story. We're now not far from retracing the complete rally from, you may remember, November 2020 was when we had the whole efficacy rate announcements from the vaccine manufacturers that led to this big risk rally. And if we get back to 128.50, that's when that risk-on rally began. And basically, cable has nearly reversed that entire risk rally. And I think it is quite significant, this bridge of 130, and we think it's definitely opened the floodgates for a further move to the downside. And there's pretty compelling reasons, I think, for investors to look specifically at the pound and differentiate to some degree compared to other countries. And of course, we had horrible retail sales figures this morning, down 1.4% month on month after a drop in February as well. But probably more notable was the consumer confidence print this morning, dropping to minus 38. And we've actually now gone below the pandemic lows, and we're back to levels of consumer confidence that we haven't seen since the global financial crisis in 2008. And that, to me, is very telling in circumstances of the cost of living crisis. Now, of course, cost of living crisis is everywhere because of energy markets, but it's the way in which Ofgem adjusts its cap twice per year means the hit that's going to come for households in April and then again potentially in October is going to be very, very significant. And I think the drop in consumer confidence today is the awareness amongst UK households of what's to come over the next 6 months, and it's resulting in a retrenchment in spending. Now, some of that retail sales print is, of course, COVID related. The reversal from COVID means there's a move away from goods consumption to services consumption. But of course, to counter that as being something we should be reassured about is, of course, the PMI services figure came out this morning, and that was weaker than expected in the UK. So, Governor Bailey spoke yesterday, and, he mentioned the very, very tight line that the Bank of England is walking between inflation and output. In other words, while they have to act to temper inflation risks, they also have to monitor the risks to output to the downside. The market has 6 rate hikes priced for the Bank of England, 25 basis points at every meeting through the rest of this year. I do not think they will deliver that. And I think, we're calling for 2 more 25 basis point rate hikes and then a pause. And, a pause could come after the next rate hike. Because I think the growth figures are coming in weaker than expected. And at some point, the Bank of England are going to pull back and pause. And I think markets are going to start potentially looking at those risks. And I think that's just going to reinforce pound selling over the short term. So I think definitely, the break of 130, I think it's opened up a credible kind of target of 125 over the next couple of weeks.
Thank you very much. Yeah, it's pretty grim thinking next 6 months or so, isn't it, in the UK? I guess, and finally then, can you give listeners an update on the trade views you publish in your FX Weekly? Yeah, well, regular listeners will know that we've been running a short euro-dollar position, and then we also had a short dollar CAD position. So effectively we were running a euro CAD cross short position. But we put them on at different times, so we kept them separate. We actually closed both of those. Euro dollar was well on the money. Dollar CAD actually was well on the money until we had a bounce in the last 24 hours, mainly on this kind of renewed risk aversion as equity markets correct lower on the rates move in the US and elsewhere. We, based on what I've just been talking about, Simon, we've put on a short cable trade idea, and I just think that what I've just run through with you just now is in large part the reasons behind that. I would also add, just very quickly on top of that, which I didn't mention a minute ago, is this news that's broken today, reported in the FT, that new legislation is about to be brought forward to Parliament, allowing the Northern Ireland Assembly to move away from certain aspects of the Northern Ireland Protocol. Effectively, a breach of the agreement with the European Union. And I think we can expect an escalation of the trade tensions that were with us last year and earlier this year. That's going to come back into the fore. And that's going to obviously be another negative kind of factor to take into account when we are assessing the outlook for the pound. And then, of course, you've got a little bit more political uncertainty. The war in Ukraine kind of moved the whole issue of Boris Johnson having to step down to the sidelines, but it's right back in front focus again with a number of senior Tory members calling for Boris Johnson to resign. We're now going to have this investigation about whether or not he misled Parliament. This is just going to run, and I think there is a renewed risk that he could have to step down. Some clients have said to me, "Oh, maybe Derek, that's a positive for sterling." And, maybe it is, but political uncertainty is back, and I think thrown in on top of everything else, I think the outlook over the short term is looking pretty grim for the pound. Thank you very much for your thoughts, and have a great weekend. We'll catch up next week. And you, Simon. Thanks a lot.
Thank you for listening to this MUFG Global Markets podcast. Rate, review and subscribe, and reach out to your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research team.